All right, we're live and it's real talk on real estate. U.S. homeowner growth just stopped and everybody wants to know what this means for them. And for those people that are sitting back going, what do you mean U.S. homeownership has stopped? That's what I mean. For the first time since 2016, homeownership has decreased by 0.1%, 1/10%. It's went down. First time since 2016. Now, the writing has been on the wall since 2018. And let me explain why it's been on the wall. The writing has been there. And I've been talking about this since 2019. I recognized it when I went and bought an apartment complex back in 2016. Largest acquisition we'd ever done. We looked at an 84-unit apartment complex, and we were able to get into that in a really good area, right off the interstate, Phoenix, Arizona, down in Tolleson, Arizona, actually, right off the I-10. And it's an 84-unit apartment complex, $7.4 million acquisition. Purchased that at an 8% cap rate. Okay, and a cap rate is the return on your investment when you pay cash for a real estate asset. Okay, now follow me here because I want to explain to you what the solution is. And those of you guys buying land, building houses, you have to pay attention, because if you don't, you're going to get crushed or you're going to miss out on opportunity. You know, where opportunity comes from is where there is, when there is blood in the water, that's where opportunity comes from. In times of distress, that's where people get wealthy. So right now, when the market is otherwise compromised, people are leaving. They're fleeing real estate. Teachers are going back to be teachers. Accountants are going back to be accountants. Attorneys are going back to be attorneys. Truck drivers are going back to be truck drivers. And rightfully so. Get your ass back to work and get out of the real estate market unless you're into this for the long haul. Even a brain dead person could make money between 2020, 2019, and 2023, guys. Even if you were half brain dead, you could make money in real estate. This is where real estate people win. And this is where it separates the men from the little boys and the winners from the losers. And let me explain how all of this is going to shake out over the course of the next 2 to 3 years. Okay, now let me finish off my story. Let's go back to 2016 and let me explain how all of this came about. Okay, I looked at numbers based on the 2008, 2009 economic crisis when Lehman Brothers collapsed. And I took the highest point of the market where the highest rent rates, where cap rates were, when things were just thriving, where prices and asset values were on homes, on multifamily, on self-storage, on retail, office, and warehouses. And I looked and I evaluated all this stuff. I had plenty of time to do it because the market was so damn slow. And so I sat back looking and going, oh my God, 2016, I was like, okay, we're sitting right at this cusp, right? So now we're sitting in 2016. This is the last dip in the market, but yet prices have escalated up to hit the 2008 numbers by the end of 2016. So it was no wonder that the real estate market dipped a little bit because people got concerned. They're sitting back going, okay, how much more can the market sustain, provided that the numbers are back to where they were at when we got into the worst real estate economic crisis in U.S. history. Okay, now we're back there again. People freak out. Okay, interest rates were also high at that time, higher than what they are actually today, and we sit back and we're scared. Now, with that said, we put ourselves in a position where in 2017 we look at a 74-unit apartment complex right down the road, and it's selling for not an 8 cap, but a 7% cap rate less than a year later. It was actually about 7 months later. And so we paid 7.4 for 84 units, better property. We went back, paid 8.2 million for a 74-unit apartment complex, 7% cap rate, less than the aesthetic value of the one we had purchased at 84 million. Now, then we go in. Now it's 2017, and we go in, we look at another apartment complex. We're in 2017, and we look at it, and the price is even higher. And I sat back, and the brokers told me, now we're at a 6% cap rate. And I sat back, and I go, no way. It just can't be. It's been less than a year and a half. We went from an 8% cap rate, 7% cap rate, 6% cap rate. I told, there is no way that this market can sustain this type of leverage. Now we're starting to escalate substantially over the price values of the 2008 recession when we were at the height of where prices and people were greedy, selfish, and doing things they shouldn't have been doing. So my brain's sitting back going, there is no way that this market can sustain this. Then I start looking at interest rates, what the Federal Reserve is doing. I sat in front of a room in Irvine, California in 2018, and I told everybody, you watch what happens. As God is my witness, this is what's going to happen. And I didn't know how it was going to happen. I didn't understand what the economic circumstances were that were going to put us in a position where real estate would go up exponentially and then cave back in. And I didn't know how much growth we were going to see from 2018 to 2021. Had no idea that the market was going to sustain the growth that it did during the pandemic. Nor did I know we were going to go through a pandemic that was actually going to stimulate economics as opposed to cripple it. And we had already been in an economic incline for almost 15 years. So I sat back knowing that something had to happen. Okay. Now, I was a lot more conservative than most people, probably could have made a lot more money than I did, but no one's crying for me. We did extremely well. I'm extremely conservative, but I want to know I'm making money. And so I said, hell with this ground up game. We're building. Why? Because the equity stance that I have when I do ground up gives me the sustainability to make larger profits, right? So 2017, when I recognized that the cap rates went from 8%, 7%, 6%, values kept climbing. I sat back and said, screw this. There is no way I'm buying these assets anymore. I'm done. Now I'm going to go back. I'm going to do these ground up. And I was conservatively underwriting these at a 15% cap rate, really stabilizing them at over a 21% cap rate. We were crushing it. So we went in. We built our first apartment complex for about $16 million, stabilized it at $32 million appraised value, refinanced out over $10 million out of that apartment complex, crushed it from all the way from start to finish. Okay, I sat back in 2018 going, this is what we're doing. We're going to go all in on this. And I already knew by the time we were halfway into this project, this was a home run. So that's when we just started turnkeying ground up construction and multifamily, where we're hitting these 100 unit, 150 unit, 200 unit developments. And now we're just fast pacing these things to come out of the ground, where we're doing $150 million a year in ground up development. Okay. Now, all of a sudden, 2021 hits and interest rates start to rise. Interest rates are not high right now, ladies and gentlemen. They just went way too low, and the prices and values of residential homes and multifamily just went exponentially through the roof. And that's with all commercial assets. So we go back in, and I sit here, and is it no shock to me that home ownership is sitting at a place where it is down to less than a tenth of a percent decline, first time in a decade? It is no surprise to me. And here's what's happening, guys. Interest rates are high compared to where they were less than 3 years ago. The cost of real estate has exponentially went up, and the average price per home has almost doubled. Did you know that back just before the pandemic, the average price per home was less than $280,000 for the average median home? Today, it's over $420,000. We've seen such an exponential increase in real estate prices, but people are freaking out on the price of the home. They're looking at the home value thinking that that's the crippling factor, and the Federal Reserve wants you to believe that that is the crippling factor and that houses got too expensive. I'm going to call the Federal Reserve's total bullshit right now. Jerome Powell, I'm embarrassed that you share a name with me, and I'll tell you that right now I'm going to call your bullshit, because this is all corruption from the Federal Reserve, which is non-constitutional. I said it on prior videos. I'm going to say it again, and I know that this may get removed for me saying this, but it's the God honest truth. So I'm going to continue saying it, selling it, and telling you guys that this is the way our U.S. economy is currently running, and it's bullshit. It's non-constitutional. Our Constitution says that nobody but our U.S. government is supposed to print money, yet the Federal Reserve is printing money for us, and it's a non-federal agency. It is ran by the central banks. The central banks are the largest banks in the world, ladies and gentlemen. J.P. Morgan, Chase, Citibank, Merrill Lynch. These are the guys running our central banks. So economically, right, these banks make money on lending money. So obviously, they're going to control the market in their benefit. Now, ironically enough, income taxes got implemented a year after the Federal Reserve was implemented in 1912. 1913, federal income taxes started getting implemented to pay back the Federal Reserve to print money on behalf of the federal government. So the corruption continues to grow. Then the Nixon era deregulates the dollar bill off the gold standard. Total bullshit. Okay. What does this have to do with today? Everything, ladies and gentlemen, because our US dollar has gotten weak. It no longer sits on the gold standard, which is true money. That's the weight of what finances actually hold, ladies and gentlemen. So watch. When we look at this now from a 2025 perspective, we're sitting back, and I want to give you guys a simple theoretical example of what the expense truly is in the market for new home buyers. Because new home buyers are sitting back going, no more. I've had enough. I can't afford the high interest rates. I can't afford the increased cost of real estate on a general basis. And most families are starting later nowadays. The days where people were getting married in their 20s is almost non-existent, and people are now starting families later, into their 30s, into their mid 30s, and even close to their 40s for a lot of people. So when we look at the millennials and we look at the Gen Z population, now we're looking at a delayed time that it takes for them to buy homes. So that's also a downward pressure on the housing market. But more so than that, ladies and gentlemen, don't buy that bullshit. It's the cost of money. The cost of money, the debt service on any asset is truly the largest expense that any real estate asset has. It's what makes or breaks a ground up development in commercial development. It's what makes or breaks new construction on anything large. Now, I would sit back, and the contrary to this is single family homes, because they are built quicker and they typically sell quicker. With the exception of the fact that you don't build what is needed in the market, you may sit on that home. And again, the debt service can cripple you in the market. So you have to pay attention to the debt service on these assets, ladies and gentlemen. You must pay attention to the debt service of these assets. So the cost of money. Okay. Now let's go through this $600,000 build for just sake of example. I always tell people, get out of the average median home that's $420,000. Let the DR Hortons, the Pulte's, the Lennar homes, let the LGI homes, Centex homes, all the big builders, let them take care of that stuff. They own the mortgage companies, the title companies, the real estate companies. They are the builder, they're the general contractor. They wear all hats. Let them have ownership of that. You'll never, ever be able to compete against these guys because they wear too many hats. They're doing massive volume. Your compressed profit is so small. It's very high risk, and the bank fills it, and they're going to make you fill it as well. In fact, the downward leverage on you building a $420,000 home is going to cost you more than building a $600,000, $800,000 home because of the spread of equity and the larger upside profitability that you have on a larger home. Okay. Now let's do this price comparison between the increase of interest rates or the reduction of interest rates by just a simple 2%. Okay. Now mortgage rates actually went up when interest rates went down a few weeks back, ironically enough. And I'll tell you that money is still trading at about 7%. Okay. So if we take a 2% reduction where money trades on a mortgage rate at 5%, just a 2% reduction, and we take a $600,000 loan on a $100,000 home or thereabouts, and we reduce that interest rate from 7% down to 5%. From where we are today, just 2 percentages, okay? So we'll have to reduce interest rates by a few basis points, and that will shave a $1,000 per month debt service off the overall house payment with just a 2% reduction in interest rates. So what I'm telling you guys, if you're buying for long-term holds, buy down your interest rates on the front end, because if you just hold that asset for about a year or two, you're going to pay for the buy down, and it's going to be upside profitability from there on out. Now, homeowners, damn it, do the same. Don't be sitting those high interest rates. Get them down, 2%. That 2% saves you $1,000 a month on a $600,000 home. Now, let's say that they lower interest rates, like Jerome Powell said, well, if we lower interest rates, it's going to create inflation. Bullshit. Let me explain something to you guys. If you take that same 2% reduction from this dipshit Jerome Powell, and you tell this dipshit to lower interest rates by 2%, that $600,000 home costs you $1,000 less per month. And even if we do experience inflation and that $600,000 home goes up by $50,000, now we would only be so lucky as developers and builders to see a $50,000 premium increase in single family homes. Very unlikely. But even if we did, for sake of example, the cost of that home, provided interest rates stabilize at 5%, is only $208 increase a month. Your cost out of pocket is over $1,000 a month with a 2% premium on interest rates and debt service. Yet a $50,000 increase in the overall price of the home is only $208 per month. You still save $800 a month if interest rates just go down 2%. So, Mr. Jerome Powell, you bullshitter, lower interest rates 2%, let inflation go. Let it go. Bringing the cost of debt service down is going to fix the economy right now. And it'll fix the housing crisis. It'll fix everything. Don't worry about supply and demand right in this moment. He could always raise interest rates again to stabilize this. But the overall cost of homes, even if they go up by $50,000, is a quarter of what it would cost us in debt service, just where Mr. Jerome Powell has interest rates today. Bring them down. Bring them down. 2%, that will fix the economy. Okay? Now, ladies and gentlemen, what does this mean for you building houses? This means you should continue building houses. Don't build in the median home sector. Build in the upper middle class, homes in excess of $600,000, and stay right around that 1.5 million on the high end. And that's a demographics that still can afford the interest payments on new single family homes. Plus, out of the 18% of homes that are purchased cash, 16% of that 18% is purchased by the upper middle class, because these are our parents, these are our grandparents, these are people that have worked professional careers and have done well over the course of time, and they're buying their homes cash. They're paying for them cash. The cost of debt doesn't make sense for them, so they're buying them cash, ladies and gentlemen. 18% of homes today are getting purchased cash. 16% of the overall 18% are getting purchased by the upper middle class between $600,000 and $1 million. You got to pay attention to this stuff, because you have to build in the sector that's purchasing, and you have to build in the sector that is not getting affected dominantly like the middle and lower middle class. Ladies and gentlemen, there is opportunity everywhere. As interest rates slowly start to decrease and the overall values of homes start to go up, the cost of money will stabilize and people will re-enter the market sooner than you believe. If interest rates would go down three more times and we get a quarter basis point reduction of each time it goes down, that in itself is going to stimulate the market, because that in itself is going to make the cost of money lower and put us in a position where affordability becomes more realistic than even the inflation of the asset itself. Ladies and gentlemen, buy land, build houses, go in the ground up game, multifamily, self-storage, and single family homes. What should you be doing? Should you be building multifamily, or should you be building homes? You should be building both, because the cash flow that backs the strength of your financials comes from single family homes. The long-term financial stability of passive residual income comes from asset ownership, and that's where multifamily comes into play, because multifamily and rents have increased at the exact same time in the first 2 quarters of 2025, where home ownership decreased by 0.1%. Rent rates have went up, and rentals and rent rates have went up by 2.6% in the exact same time period. that the ownership has went down by 0.1%. Buy land, build houses, scale into multifamily, and crush profits long term. For more content just like this, click and subscribe to our YouTube channel, pound that thumbs up button, and give us some love. And until next time, ladies and gentlemen, comment down below and share with us your thoughts on what's happening economically. Click and subscribe. And until next time, God bless you, and go out and compound your success.